Well, good morning, everyone, and very warm welcome to all of you from KPMG in Oman. I'm Ken McFarlane, partner in charge for KPMG in Oman, and I will be introducing today's session on considerations for the retail sector as businesses get ready for the implementation of VAT in Oman from 16th April 2021, which is less than 40 days away. It's quite a scary thought. So before I begin, let's just go over a few administrative matters. If you could please key in your questions throughout the session, anytime throughout the session, using the Q&A tab on the right-hand side. We'll address as many as possible during the Q&A session at the end of the webinar presentation. Please do take a minute to complete the short survey at the end of the webinar. Your feedback is very valuable and will help us shape future sessions. Finally, this session is being recorded and will be shared with you in the follow-up email later on. Now, let's look at the agenda for today's session, which will take about 1 hour. After the introduction, we'll give you a status update on where things stand with Oman VAT implementation. We will then go through the Oman VAT framework as set out in the VAT law, which was issued 5 months ago. And then we'll move on to look at specific issues related to the retail sector. You will need to consider these issues while you configure your IT systems and ERP to be VAT ready. We will talk you through the next steps and mission critical items that you need to prioritize to be ready for the go live date. To go through all of these topics, we have a distinguished panel of VAT specialists from our firm. We have Abha, who I'm sure is a familiar face to most of you and has been in Oman for the last 3 years. She's helped establish a strong indirect tax practice for the firm in Oman to complement our well-recognized corporate tax practice, who, as you all know, led by Ashok Hariharan. But Abha has also played a very important role in sharing insights on VAT with businesses and also with the tax authority. We also have Dermot, who is a retired KPMG partner with over 40 years of indirect tax experience across UK, Australia, South Africa, and the UAE. He's now in Muscat supporting our indirect tax practice and clients with the Oman VAT implementation. Lastly, we have Julie, who is our indirect tax technology specialist. Julie has helped clients with VAT implementation in the UAE and has been helping businesses in Oman with VAT implementation in their IT system. So I'll now hand you over to Abha, who will provide a status update. Abha, over to you.
Thanks, Ken. Good morning, everyone. Thank you for taking the time to joining us today. So the VAT law was published on the 18th of October 2020. Takes effect 180 days from the date of publication, which is why we go live with VAT on the 16th of April 2021. In January this year, the tax authority has issued 3 decisions, of which 2 are on registrations. One decision reiterates the monetary threshold for mandatory and voluntary registrations. So mandatory registrations are for businesses with supplies in excess of 38,500 Omani riyals per annum. Voluntary registrations for businesses with supplies or expenses in excess of 19,250 Omani riyals per annum. The other decision staggers the registration and go live. It's quite similar to Bahrain, but different monetary threshold. Businesses with annual supplies in excess of 1 million Omani riyals must register with effect from 16th April 2021. 500,000 to 1 million from 1st July 2021, 250,000 to 500,000 from 1st October 2021, and the last tranche is 38,500 to 250,000 who need to be registered by 1st of April 2022. Now, businesses eligible for voluntary registrations may apply at any point in time. There are different registration processes for resident businesses with commercial registration as well as without commercial registration and non-resident businesses. The monetary threshold does not apply to non-resident businesses liable for registration in Oman. The tax authority has launched the registration portal on the 1st of February 2021, and it remains open for the first tranche of registrations till the 15th of March. It's just 5 days away. Although the criteria for tax grouping hasn't been published yet, the portal allows registration of tax groups. But in order to create a tax group, all members of the tax group must first be registered independently. And based on the guidance that the tax authority has recently issued, an entity in a special economic zone or a free zone cannot be a member of a tax group with entities that are in the mainland, i.e., that are not in a free zone or a special economic zone. Now, while the law sets out the framework, as I say, the devil lies in the detail. And the detail on a lot of substantive as well as procedural aspects are expected to be set out in the executive regulations. The final regulations are currently awaited. Technically, the tax authority has up to 6 months after go live to publish the final executive regulations. So in the worst case scenario, it's possible that the executive regulations may be published as late as October 2021. But what we understand from the tax authority is that they are working with the Ministry of Justice and Legal Affairs to release the executive regulations as soon as possible and hopefully before go live on the 16th of April. The tax authority is also working on issuing general and sector specific guides to allow businesses additional guidance. But even then, at this point in time, there is clarity required on several aspects for businesses to plan for implementation and make system changes. And the list is long, and what we have on the slide is only illustrative. It's not exhaustive. Clarity is also awaited on certain notification or approval processes. For instance, deferral on import VAT, simplified billing, third-party billing, exemptions from registration. And then there's formats of tax invoices, simplified tax invoices, credit notes, debit notes, VAT returns, VAT refund applications. And all of this needs to be done before we go live on the 16th of April. So that's the gist of where we are at this point in time. I'll ask Dermot to walk us through how Oman VAT will work once we go live. Dermot, over to you.
Thanks, Ava. Good morning, everybody. Just going to spend about 10 minutes or so with you this morning on explaining a little bit again about the principles of VAT and where it comes from, which will help you understand some of the issues. Apologize if you're already well versed in all of this, but given that the tax is new to Oman, it's probably not a bad idea to have a quick refresher, which is what we want to do at this point. So VAT is a consumption tax charged at each stage in the supply chain. It's not meant to be a tax on business. It's meant to be borne by the final consumer. In some instances, such as for exempt supplies, the supplier steps into the shoes of the final consumer, but we'll come back to that in a little bit more detail later. There are many exceptions and complexities. VAT was originally invented by a Frenchman called Maurice Lauré in 1954, and it was designed as a replacement for a whole series of different turnover taxes and sales taxes in Europe prior to the setting up of the European Economic Community, which ultimately became the European Union. So don't blame us, it's all down to the French, I'm afraid. It now applies in 169 countries worldwide, including some of the Gulf states. UAE and KSA came on board in 2018 and Bahrain in 2019, with Oman obviously in 37 days time or so. Next slide, Claire, please. So there are a couple of principles and terminologies that we use. I'm not going to go through all of these, just going to highlight some of the more relevant ones, and I'll go through some of them in a little bit more detail. The first one I wanted to mention was supply. Normally in business you talk about sales, and indeed sales are supplies for VAT purposes, but so are a number of other things. So it's important to remember that it's not only sales. You can have a deemed supply, which will apply to free goods. You can have a removal of inventory for personal use, which can also be a deemed supply. So there are more things in supplies than in sales. I also wanted to touch on another concept called the reverse charge mechanism, which is very unique to the world of VAT. Reverse charge applies to imported services into Oman by registered businesses, where the supplier has no place of business in Oman and is not registered for VAT in Oman. In those circumstances, the imported services wouldn't suffer VAT in the normal course. So the reverse charge mechanism steps in to make the recipient of the service effectively the taxpayer, and you have to charge VAT to yourself. If, however, you use those supplies for the making of onward taxable supplies, be they 0 rated or 5%, you're entitled to an input credit in the same period. So it can be just a bookkeeping entry. If, however, you use those services for an exempt supply, you're specifically prohibited from claiming the input tax, so it will be a liability. Next slide, Julie, please. I keep saying Julie and it's Claire. Apologies, Claire. There are 3 different types of supplies that I want to cover just briefly here. Standard rated supplies, which we call, refers to the standard rate of 5%. Just in passing to say that global average rates of VAT range between 15 and 20%. So at 5%, Oman is substantially lower than the average. And even in the region, UAE is 5%. The KSA started out at 5, but went up to 15. So there is scope for changing in the rate in the future. 0 rated supplies and exempt supplies are important because they sound like they should be the same, but in fact they're very different. A 0 rated supply is a supply that is subject to VAT at the rate of 0, and it allows the supplier to recover all input tax he incurs on any purchases or overheads. An exempt supply is specifically exempt in the legislation, and it means that the supplier doesn't charge VAT, similar to 0, but the notable restriction is he cannot recover any input tax on his purchases or overheads that are directly related to the exempt supplies. If you move on, Claire, please. So the legislation sets out the activities that are exempt from VAT. They're there on the screen. You can read them yourselves, notably healthcare goods and services, to be distinguished from specified medicines and medical equipment, which are in the 0 rated column. We await the executive regulations to get more definitions on what will qualify under both of those categories. Main other exemptions apply to financial services and to residential property, as well as local transport. 0 rating applies on certain foodstuffs and on the intra or international transport of goods or passengers. There are 2 other categories that I didn't mention before: suspension and out of scope. Suspension are goods that are under a customs duty suspension regime, so they also have a special treatment in the VAT legislation. And out of scope are supplies which are just not subject or within the ambit of Oman VAT law. An example there would be where somebody based in Oman sells goods that are located in a 3rd country to a customer in a 4th country, all outside of Oman. They are outside the scope of VAT. If you keep going, Claire, please. So, as I mentioned earlier, there is a concept of deemed supplies in the legislation. The banner at the middle sets out the important first test. Input tax related to the goods or services has to be deducted by the taxpayer in order for the onward deemed supply to attract VAT. So if you don't claim the input tax, you can't have a deemed supply. It's a basic rule to remember. What are deemed supplies? Supplies of goods or services without any consideration, or the changing of the use of goods from a taxable purpose to a non-taxable purpose, or the appropriation of goods from business to a person's personal use. Also retaining goods after the ceasing of a business and assigning them to another purpose. So those are what are deemed supplies. Have the next one, Claire, please. There are specific rules around time of supply. I'm only going to cover the general rule in this session due to time constraints. The others are there, and but the general one is the first and most important one to remember. The time of supply is the earliest, and I stress earliest, of the date of supply of the goods, the date of issue of the tax invoice, or the date of receipt of payment, whichever comes first. And if you receive a deposit or an advance payment for either goods or services, then you are assessed to have made a supply at the time of receipt of payment up to the value of the amount of the advance or deposit received. We'll keep going, Claire, thank you. So place of supply determines which jurisdiction has the taxing rights, and there are specific rules. The basic rule is that in relation to a supply of goods, where those supplies are made without transport, it's where the goods are made available. And I guess in a retail environment, that means the retail store, where the goods are physically made available to the customer. If they are subject to delivery or transport, then it's where the transport commences. Specific rules in relation to oil and gas, which we won't cover, as it's dealt with in a separate session. VAT legislation defines supplies of goods, and then it says that anything that's not a supply of goods is deemed to be a supply of a service. And please remember that supplies of services can include passive activities, i.e. if you received a payment to get you to refrain from doing something, that too is a supply of service. And then there are some special cases which are listed on the side. Telecommunications, in context of retail, the bottom one, restaurants or culture or sporting activities, are important because the place of supply is where the actual service is performed. The next one, please, Claire. So input tax recovery is an important concept. It is allowed where the goods or services are used or are intended to be used for taxable supplies. There's a two-stage test. You look first to see, are those goods or services directly attributable to the making of a taxable supply, i.e. a supply at 0 or 5%, and if so, it's recoverable in full. If it's directly attributable to an exempt supply, then it's not recoverable. And then where there are supplies such as overheads, which are used for both purposes, you'll have to do an apportionment. There are two specific boxes there in red that I wanted to mention. There are certain prohibitions on input tax recovery, and they are blocked on goods that are prohibited to be imported or supplied in Oman. And they're also blocked on certain specified categories of expenses, such as entertainment and motor vehicles for private use. We'll move on to the next one, please, Claire. So VAT compliance, we break down into three categories here. There are the records that you must keep, and those are listed there, tax invoices, etc. If you are involved in issuing invoices in a foreign currency, there are specific requirements to convert those into Omani Rial on the face of the invoice as well. And then there are rules around the time period for retention of records. The standard is 10 years, but if it's related to real estate, it's 15 years. Tax returns, for the moment, we're starting off that on a quarterly return basis. But for larger taxpayers around the world, the norm is generally monthly. So don't be surprised if this moves over the next year or two onto a monthly return filing once the system is up and running. All right. Refunds, obviously, if you incur an excess of input tax over your output tax, so for example, if you were involved in the retail sale of wholly zero-rated items, but you would have VAT on your overheads, your rent, your light and heat, your professional services, etc., you will get a refund of the VAT paid in excess of the output tax. Moving on, Claire, please. Okay, we're going to move to the detail now with Abba on some of the specific items that you have to watch out for in the retail sector. Thank you.
Thanks, Dermot. Now to the peculiarities of the retail sector. We've put out a few issues that we think are important for you to consider, but this is not an exhaustive list. This is only an illustrative list. And while we'll discuss general scenarios, we need to remember that before we conclude on the tax treatment on any transaction, you need to look at the specific facts of your case, the contractual arrangements, the commercial obligations, and everything that surrounds the transaction. So, bill to ship to arrangements. Common phenomena in the retail industry: you bill to a certain party, ship to another party on the instructions of the bill to party. Now, these require a careful application of your place of supply rules. As Dermot mentioned earlier, when supply is with transport, the place of supply is where the transport begins. When the supply is without transport, it is where the goods are made available. So the taxability in case of local bill to ship to transactions is not a difficult one to deal with, because your bill to party is also in Oman, your ship to party is also in Oman. So unless the goods that you're supplying are zero rated or exempt, you would usually apply the standard rate and charge a VAT of 5%. The complication arises in transactions where the bill to and the ship to party are into different jurisdictions. If your bill to party is a local customer and they instruct you to ship the goods to an overseas location, the question is, would these qualify as an export of goods? Or in another scenario where the bill to party is a non-resident customer and requires you to ship the goods to someone locally, how would you treat these transactions? Would you go by the place of the customer, the bill to customer, and treat this as an export? Or would you go by the fact that the goods are moving from Oman to within Oman and charge a 5% VAT? If you do charge a 5% VAT, if the transaction is going to be taxable, would it create a compliance or a registration obligation for your non-resident customer to register for VAT purposes in Oman? If the non-resident customer does not register for VAT in Oman, will he or she be eligible to claim the credit of the VAT that you charge on your invoice to them? So a lot of things that you need to consider when you enter into bill to ship to arrangements, especially as I mentioned earlier, where the bill to party is in one jurisdiction and the ship to party is in another jurisdiction. And then there are special arrangements which are also common to the retail industry, drop shipments, where you may purchase goods from outside Oman and sell them outside Oman. So the goods will never physically enter into Oman or leave Oman. In such circumstances, will this transaction be treated as out of scope because the goods were never in Oman? And if these transactions are treated as out of scope, then would it in any manner impact the input tax that you intend to recover on expenses that are directly or indirectly attributable to these transactions? And then there's consignment sales. In case of consignment sales that you have with a local party, you may put stocks at your local party's local customer's disposal, and you may sell them only at a later point in time when he calls on these goods. What is the time of supply? Is it the time when you put the goods in your customer's position? Or is it the time when he actually calls on the goods and you sell the goods to him? Or if you don't sell the goods within 12 months or 24 months, is there a time limit within which you are required to raise the invoice? So consignment sales locally require a careful consideration of the time of supply so that you're able to ascertain the timing of your tax obligations appropriately. In instances where you have a consignment arrangement with an overseas party, you may have instances where the principal may put an overseas principal or a foreign principal may put stocks at your disposals in Oman. You may call on them as and when you require, and the principal may bill you at that point in time. Now, by putting stocks at your disposal and transferring ownership in these goods while the goods are in Oman, does that create a registration obligation for your overseas principal? Will he or she be charging you a VAT on the transaction if the goods are not zero rated or exempt, that needs to be looked at. And in such instances, you need to look beyond VAT. By having these consignment arrangements, is the foreign principal creating a permanent establishment exposure for their business in Oman, because of which they may have corporate tax obligations, and the profits that they make from Oman may become liable to corporate tax at the rate of 15%. So it's not just VAT, you would need to look at the overall transaction and the implications for business. Schemes and promos, whether it's schemes that you extend to the ultimate or the retail customer, or schemes that you're eligible for as a retailer or a distributor of a particular product. So it's common to see when you go to the supermarket or outlets, where you have transactions where there's buy one, get one free, or buy 10, get one free. In those instances, is the product that is supplied free of cost creating an exposure of deemed supply? So while you're not charging your customers separately for this particular product that is being called or marketed as free, does that create a VAT obligation for you on the supplies? If it does not create a VAT obligation for you on the supplies, does it hamper your ability to claim input tax credit on the purchases that you've made that are directly or indirectly related to such free of cost supplies? So deemed supplies is a concept that you certainly need to evaluate. And in certain instances, you may even need to look at changing the schemes that you have. You may have instances where products are bundled and sold at a single consideration. And when you bundle these products, it's possible that there may be a taxable product, which is a standard rated product, which is being supplied with a zero rated product. In that case, how do you treat the single consideration that you charge for the purposes of VAT? Or when you bundle a standard rated product with an exempt product, or whichever permutation combination you may do this in. All of these schemes would have to be looked at. In certain cases, considerations may have to be split. In certain cases, you may need to look at whether these are single supplies, these are composite supplies. You will, of course, in order to arrive at the taxability, need to classify the supplies appropriately to identify whether there is any bundling of supplies that have a different tax treatment. You may also have discounts that you put on the face of the invoice, which are slightly easier to deal with, but you may also have post-sales discounts, which you may give in the form of a coupon. So I may buy something, you may issue a coupon to me, which I can use at the next purchase that I make. How will these be treated for the purposes of VAT? And then there's also the secondary schemes, which are extended by principals, where expenses, that's the advertising and promotion expenses that are incurred by retailers, can be charged back to the distributor. Are these services that the retailer is providing to the distributor? Should you be issuing a tax invoice for this? Should you be charging a VAT on these transactions? If you're charging your customer any sort of listing fee or placement fee or charges for something that you've done, you may not have issued invoices in the past. These amounts may have been netted off from the consideration that the principal pays you. But will that be the practice even after VAT is implemented? And there are grander schemes that you see where there's lotteries. Malls conduct lotteries where, depending on the value of purchases that you've made or the shopping that you've done, you may be eligible for a lottery draw and you could win something as big as a car. How do you treat those transactions? Is the car a gift? Is the car a business expense? Would it be seen as a deemed supply, or would it create a question on your ability to claim input VAT incurred on the purchase of such gifts which are given out in lotteries? Each scheme may have a different tax implication and will therefore have to be looked at separately. Vouchers, single purpose vouchers, multi-purpose vouchers. What is the tax treatment? What is the time of supply? Do you charge VAT or pay VAT to the tax authority at the time the voucher is issued? Or do you pay tax to the tax authority at the time the vouchers are redeemed? On what value do you pay the tax? Requires careful consideration. Loyalty schemes. You may have loyalty schemes where customers may use the loyalty points as a discount for the purchases they make from you or your retail chain. Or you may have loyalty schemes which are much more wider, and customers can use the loyalty points to even buy goods or services from other brands, from other service providers. What will be the treatment of loyalty schemes? What should be your display price? Should it be inclusive of VAT? Should it be exclusive of VAT? If you look at the Oman VAT law, it says that when the prices are displayed, these should be inclusive. But when you look at the transitional provisions, it says that in order for you to recover VAT from your customer, your prices, you should have the right to recover VAT or a VAT recovery clause in your contracts. How do these two concepts reconcile? Classification of supplies. As Dermot mentioned earlier, there are different exemptions, there are different zero ratings which are available and may apply to the retail sector. You have medical equipments and medical products which are zero rated. You have food products or food items which are zero rated. And one of the decisions that the tax authority issued in the month of January lists 93 food items that would be eligible for zero rating. You have healthcare products and goods and services related to healthcare which are exempted. So you would need to look at each and every product and ascertain the tax treatment. And before you conclude on whether it is eligible for an exemption or zero rating, you would need to wait for the executive regulations to see the conditions that are attached to the exemption or zero rating. So for instance, crude oil, natural gas, and oil derivatives, and particularly oil derivatives, are intended to be zero rated. But would they be zero rated when these are sold at petrol stations, or would it only be when these are a part of B2B supplies? So it's important that you understand the taxability of every product. If there is a VAT liability, if the transaction to be rated, but you zero rated, then the obligation or the exposure that you run is that the tax authority may come back in the future, not just recover the differential tax, but also impose administrative penalties and additional tax, which could be quite onerous. On the other hand, you could have instances where you may not assess the tax treatment on a particular product correctly, charge a 5%, and then realize that it was eligible for zero rating, in which case you've overpaid the tax. You've now got money with the tax authority, which you may be able to reclaim as a refund, but that will take its own time. And not to mention that if you're selling a particular product with a 5% VAT and competition is selling something with a zero rate, that will perhaps have some impact on your standing in the market. But those are matters beyond VAT that you need to consider. Invoicing arrangements. If you look at the GCC countries where VAT has been implemented, they have the concept of simplified invoices, where if the supplies are of up to a certain value, then you do not need to issue a detailed tax invoice. A simplified invoice with lesser details will be acceptable. Is that possible in Oman? What would be the criteria? Would you require a special permission from the tax authority to be able to issue these simplified invoices? And third-party arrangements, third-party billing arrangements, where you may be allowed to issue invoices on behalf of another party. Whether that's something that could come handy for your business model. If yes, would that require a permission or an approval from the tax authority? Would these permissions, whether it's for simplified tax invoices, whether it's for third-party billing arrangements, would they be required on a periodic basis? Would it be a blanket approval? So all of these are matters which will require consideration and planning. There's transitional contracts and supplies which you will need to watch out for. The Oman VAT law is clear that if you make supplies after the 16th of April, then VAT, unless the goods are exempt or zero rated, will have to be paid to the tax authority. Doesn't matter if you've raised the tax invoice before 16th. Doesn't matter if you've raised the invoice before the 16th. Doesn't matter if you've received the advance before the 16th. If the supply is on or after the 16th, VAT will have to be paid. Whether you're able to recover this from the customer or not will depend on your contractual terms. If your contract allows you to recover VAT or your prices are exclusive of VAT, then you can recover this from the customer. If the prices are not exclusive of VAT or the contracts do not allow you the right, then your supplies or the consideration for the supplies will deem to be inclusive of VAT, and this would have to be borne by you as the supplier. It's also important to look at how you treat transitional supplies where you've made a sale before the 16th of April, goods are returned by the customer after the 16th of April. How do they impact your VAT obligations? And likewise on the purchases. If you've purchased something before the 16th of April, but you but you return these goods after the 16th of April, how will it impact your VAT obligations? Supplies by non-resident businesses, where you have someone supplying goods, whether it's an e-commerce company, whether it's a business who's making supplies to a local entity which is not registered for VAT. They may be not registered for VAT either because they don't cross the threshold for registrations, or they do cross the threshold for mandatory registrations, but not required to register from 16th of April. They are required to register from a later point in time. Does this create an obligation for the non-resident business to register in Oman to fulfill the VAT obligations, to ensure that the goods are cleared from customs on payment of appropriate VAT? And then there's cash flow and profitability impact that each of these transactions is going to have on your overall business. For instance, when you import goods into Oman, the general rule under the Oman VAT law is that VAT at the time of import would have to be paid in cash upfront at the time of customs clearance. If you're eligible to recover the input credit, you can do so on your return, but this creates an immediate cash flow impact for you. There is a provision under the Oman VAT law that allows businesses to defer the liability from the time of customs clearance to the time of filing of the returns. But in order to qualify for the deferral, you need to make an application to the tax authority. The tax authority needs to approve of it, after which you can put this in place. The profitability, when you're looking at your promo schemes, when you're looking at your contracts, when you're looking at your ability to recover VAT from your customers, all of these play an important role. Now, of course, there are optimizing opportunities available in the law and will be clarified in the executive regulations, but all of that requires careful planning ahead of time. So those are the few issues that we wanted to talk about today. With that, while these are the VAT issues, there's a whole host of other issues that need to be dealt with on the IT and the system side of things. And I'll ask Julie to take the next section where she walks you through the VAT touch points on the IT systems. Over to you, Julie.
Sure, thank you, Abba. It's probably a very busy slide, but what this slide actually shows you is that there are a lot of VAT touch points in your IT landscape, and you actually are required to at least know which ones of those are relevant for you or not, and how you deal with them. And given we only have more or less 1.5 months left before the implementation, definitely you need to determine, you need to review your systems and have a good idea of what is relevant for your business or not. Based on our experience with retail businesses, your IT landscape might be more complicated than for others, because you are not only dealing with your core ERP, you're also dealing with possibly other point of sale systems that they are equally connected to your main ERP, but those systems might need to produce their own invoices with their own invoice layouts, with their sequences, and possibly also that need to comply with the simplified invoice requirements rather than the full tax invoice requirements. So I would say for retail businesses, probably there is more variation that needs to be looked at. and therefore at this point of time you should already at least know what touch points do you need to address, and what do you know, and what are still unclear points that would need refinement after we have the executive regulations. But if you look at the whole suite of things that are mentioned here, it all starts with the master data, because the quality of your master data will determine how compliant your tax determination will be and how good your reporting will be. So even in the absence of all the details in terms of the VAT treatments or even document requirements, we still can do a lot in making sure that the master data that you have in your systems is good enough to do whatever VAT determination will be required of you. So for those of you who are already registered, and you might have already seen that there is this exchange of information happening already on the market in terms of exchanging information about the tax registration numbers. So why is it important? Because the expectation is that you would need, you would definitely need to make sure that you mention this number on your own invoices, but likely that you will need to have those invoices, those numbers from your customers, and mention those on your invoices as well. This number is also an indication whether your vendor is tax registered or not, because once somebody charges you VAT on the 16th of April, you do want to check, is that correct that this person is applying VAT? Are they registered themselves? And how you can check it is by knowing whether they have their VAT registration number. So by already collecting this information and making sure that that information is captured in your systems, that will allow you to have enough controls to know whether VAT should be applied or not. So that is something that you can do independent of whether actually that number will need to be on your invoice or not. You can also already set up your tax codes in the system, because especially on the purchaser side, you will most probably be, you would need to process all the different purchase types in terms of local supplies, imports, services from outside of Oman. So all of that, all of those variations would be relevant, and therefore it's better to have all these tax codes already in place, and to be sure that whatever purchase transaction happens, that you're actually able to process it in your system, and especially have granularity in your system to produce the report that will allow you to fill in the declaration. If we now don't know how detailed the declaration will be, but what we know from other countries that recently went live with VAT, that most probably the format of the VAT return will only be known, my guess is in June of this year, because July will be the first reporting period. So that means that you can't wait until then. Sorry, just mute by accident. So you can't wait until you have that format to determine how granular your tax codes should be. Your tax codes need to be already set up in the system with all the granularity, because it's much easier to take two tax codes and put them together in one box of the VAT, and at the moment of reporting, trying to dissect different types of transactions into different types, different boxes of your tax return. So I think and last point that I want to mention, because we do want we have quite a few questions in the Q&A. One last point what I want to mention is that you will need the tax invoice is a crucial document, not only for yourself to determine your tax liability, but also for your customer, especially when it's a B2B transaction, because your customers will want to take input tax credit. So you need to identify where all of the invoicing is taking place in your system, what is going as an automated invoice, where do you have maybe some manual processes, maybe intercompany invoices that that are done not through a regular standards type of invoicing. Also, the difference between a full tax invoice, a simplified invoice, as I mentioned, if you have point of sale systems as well, because you need to know what all those forms are to make sure that starting 16th of April, all of your forms and invoices that are being used to exchange between yourselves and your customers, they are tax compliant. Because you don't want to be in a situation when people still use old document types and issue an invoice or something like that looks like an invoice but does not have all the requirements of a tax invoice. So with that, this is just a few things that you already can address and you should be looking at. Obviously, there is more to handle, but given the number of Q&A questions, I'm giving it. Sorry, I'm first giving it back to Abba to also discuss the next steps that that we're suggesting to look at.
Thanks, Julie. So the consistent message that the panel is trying to give you is that VAT impacts all facets of business. It's not just a tax or a finance project, it's a business transformation project. And businesses need to look at every part of their operations to be VAT ready, work collectively towards a smooth transition. Now, VAT implementations can be complex, especially when the legislation is not published, but they're not impossible. So with 5 days to go for registration, 37 days to go for go live, and 142 days to go for the first return, prioritize. Let's look at some of the mission critical items that you need to cover between now and go live on the next slide. You need to understand your registration obligations. Claire, if we can go to the next slide, please. Thank you. So you need to understand your registration obligations, know your registration options, whether you qualify for a mandatory registration or a voluntary registration, whether you need to register as a VAT group or obtain an independent registration. Weigh the pros and cons before you make a decision and apply, but register in time, because if you fail to register in time, you could be attracting penalties even before you've started VAT implementation. VAT is a transaction tax. List down all the transactions, procurement, supplies, capital expenditure, employee policies, and understand the tax treatment so that you're able to treat them right and you're able to discharge your VAT obligations correctly. Apply for exceptions if you're eligible, deferral for payment of VAT at the time of imports, exemption from registration in case of zero-rated supplies, special billing arrangements, review contracts, review price lists. VAT is not intended to be a cost to business, but in the absence of a VAT recovery clause, because of the transitional rules, you could end up paying VAT out of your own pocket. You also need to make sure that when you're advertising prices, you advertise them right. Because in the UAE, we've had instances where the FTA has looked at how prices were advertised by suppliers in the newspapers and then imposed penalties for non-compliances. Understand the impact on IT, masters, tax determination, document layout, tax reporting, and identify the VAT touch points in the IT landscape. Configure and test your systems and plan a cutover strategy. A transition to VAT generally requires careful planning. Having to transition in the middle of the month only adds to the complexity. And train, educate your team, operations as well as frontline. because you are going to get questions from your customers, and you need your frontline staff to understand why you're passing on a new tax to the customers. Educate your customers, educate your vendors, and finally go live. But that's not where it ends. That's just the beginning. There will be clarifications after the 16th of April. You may need to reassess your tax position. You may need to revisit your system's configurations. So stay agile. With that, we can wrap up the presentation for today and move into Q&A. Thank you, everyone.
Thank you, Abba and Julie. I'm going to moderate the questions that I can see on the Q&A box. So the first one that's come in, Abba, I'm going to give to you. It says that oil and oil derivatives are zero rated in the legislation. Does that mean that fuel at the pump, I assume petrol in this case, or diesel, will also be zero rated?
Good question. If you look at the law, then it only talks about zero rating crude, oil derivatives, and natural gas. Petrol and diesel, of course, could fall under oil derivatives. What the law does not say is, does this zero rating come with conditions attached? And that's something that the executive regulations would clarify. We would expect, based on our discussions with the tax authority, that the conditions may limit the zero rating for B2B supplies. And even if you look at the rest of the region, UAE, when fuel is sold to retail customers like you and I at petrol stations, it is liable to VAT. It is not zero rated. But on the other hand, if you look at Bahrain, Bahrain zero rates the supplies even to retail customers. So I think we will have to wait for the executive regulations to see what kind of conditions are attached to the zero rating, and then make a decision on whether Oman will or won't apply VAT on the sale to retail customers.
Great, thank you for that. Julie, one for you. A question on a difference in timing between a goods received note and the actual invoice from the supplier. The invoice always comes in later. Which is the time that you can claim the input tax?
You do need to have the tax invoice from your supplier before you can claim the VAT. So that's definitely not the receipt of the goods, not the receipt of the delivery note. And even if you made the prepayment, even then you can only claim the VAT once you have an invoice from your supplier. So that
Great.
document, that's why I mentioned also in my part of the presentation, the tax invoices will become the most important document, not only for the seller, but also for the purchasing party.
Okay,
And
sorry, go ahead, Ava.
And if you look at, compared to the UAE, Oman laws are a little more lenient, a little more liberal, because the tax law does allow you to claim input tax credit up to 3 years from the tax period in which the right arises. So unlike the UAE, where you need to make that decision and claim input tax within the tax period or the tax period that immediately follows. So yeah.
Great, thanks. Either Abba, as soon as you're on, maybe you take the next one. The question is, the 15th of March is the hard close for registrations for large businesses. Will the portals not be available after this date?
So this is something that we've also been trying to discuss with the tax authority. It's unlikely that the portal will be discontinued or inaccessible, because businesses that need to register voluntarily or opt to register voluntarily can do so at any point in time starting the 1st of February 2021 onwards. So we would expect the portal stays open. The only question is, one, will the tax authority extend this timeline of 15th of March to beyond? And that will depend on how many businesses have already managed to register versus the expectations of the tax authority. And two, if the portal does stay open and a business applies for registration, will the effective date of the registration still say the 16th of April, or will it get pushed back? So that's what we know at this point in time.
Okay, I'm going to bunch two questions together, and again, either of you could take. They're both in relation to expenses for goods made available to employees. So in one instance, I think it's food items which are purchased. They can't distinguish the items that are bought for resale and those that are bought for employees. And the other one is a reimbursement of travel, hotel expenses, etc. Is the VAT recoverable by the business where those are reimbursed to the employee? Either of you happy, whichever wants to take that.
Julie, do you want me to take that, and then you can
Sure.
add experience that we have from UAE? So let me start with the second one, Dermot, on expenses that are incurred by employees, where these are travel expenses or where these are hotel expenses or food expenses. I think consistently when we've seen the VAT legislation around the GCC, expenses that are related to entertainment have been blocked. The only question is every country has had its own interpretation of what is the scope of entertainment. So it could be as narrow as when you have parties, iftar lunches, iftar dinners. It could be as wide as any sort of hotel accommodation, any sort of travel. So we do expect that the Oman VAT legislation will also block credits on entertainment expenses. The question is, what will be the scope of these entertainment expenses? We would assume that to the extent the expenses are incurred in relation to the business, are essential to the business, you should be able to make some sort of a claim. But again, this will depend on the conditions that are set out. The other practical consideration in recovering input tax credit on such expenses is that it's important that the invoice is in the name of the business. If the invoice is not in the name of the business, if the invoice is in the name of the employee, then that may create a larger question on the eligibility for this input tax, because you don't have a valid invoice in the name of the business. So that was on the second question.
Great. Julie, anything you wanted to add, or are you happy with that?
Yeah, no, agree on everything. Yeah.
Okay.
And
Conscious, we're almost out of time. Sorry.
just on the first question that you asked about employer-employee transactions. Now, I think we need to be careful over there. Employers and employees can be treated as related parties. So any transaction that is outside the scope of employment between these two will need to be benchmarked at fair market value. You will need to assess whether you're creating a VAT obligation for yourself or if you've claimed input tax. So each of these would have to be looked at on a case-to-case basis. Sorry.
Great, thanks. Conscious that we've just run to the end of our time, we'll keep going for as many people that are willing to or able to stay on for a little while longer until I just get through some more questions. Another one, I think this is rather important, and maybe Julie, you could look at this or answer this one. What, if any, is the VAT implication of stock that's on hand at the 16th of April? Obviously, this is stock that was bought before the introduction of VAT that's going to be sold after the introduction of VAT.
So the stock itself, as long as it's already invoiced and the stock is already delivered, that does not create any additional exchange because you've already purchased that. Where, for example, it's stock in transit, that's where it kind of gets a bit blurry because your supplier might have already dispatched the goods and they're in the process of transportation, and would you need to consider the fact that the goods have arrived on your premises on the 17th, that should trigger VAT application? Or should you go with the fact that the goods were dispatched by your supplier on the 14th, that determines the tax liability? Hopefully the executive regulations will give us a bit more of the details, what you need to look at in terms of that cutoff date. But the goods that are already at your premises, that are already received and invoiced, no issue there.
Okay. There's a question here on prices being displayed by retailers. Is the understanding that they'll be displayed VAT inclusive? I'll answer that one myself, and the answer is yes. So it's going to be important on the evening of the 15th of April to go around and amend all your prices. You can't merely put up a notice in the store that says all items are plus 5% because of that. You actually have to mark the individual items or the shelf display price as being the new price, including VAT. Abba, maybe you'd answer this one. Customer's VAT number mandatory on my invoice. I guess that's the question, is it? Is that true for simplified invoices as well?
Right. So I think, so while I said yes, that yes is based on how we've seen the legislation evolve in the rest of the region. Because if you look at the Oman VAT law, which is available in public domain at this point in time, it does not say what contents need to be put on the tax invoice. What we do know is the tax authority has put a illustration, or an information sheet sometime late last year, in which they've given a document layout, which is akin to an invoice. That does require the VAT registration number to be displayed. So that information sheet with the rest of the legislation in the GCC, we expect that that would be a mandatory detail on the tax invoice. Whether simplified invoices will need a mention of the VAT registration or not, again, having looked at how the region treats simplified tax invoices, we would expect yes, because the VAT registration number is that unique identification number that the tax authority can trace you by.
So I guess in a retail environment, sorry, go ahead, Judy.
Yeah, so I think, Abba, you mean the VAT registration number of the supplier for the simplified invoice, because the customer obviously might not even be VAT registered, so the customer not, but you as a supplier, your own VAT registration number needs to be on even the simplified invoice. So even your point of sale till receipts, they would need to carry that that registration number.
Yes.
And Julie, that leads me to a question I was going to add on to that was, obviously in a retail environment, a significant number of the customers will be private individuals and not need a valid VAT invoice. But do you foresee that retailers will need to have the capability to issue a proper tax invoice if somebody turns up and says, oh, well, I'm actually buying these supplies for the business, you know, I go in to buy a whole lot of cleaning supplies for the office, and therefore I want to be able to claim the VAT back.
Well, the thing is that you are required to issue a proper tax invoice, independent whether you supply to a business or to a private person, because it is the obligation of the supplier. As we see in other GCC countries, there is a difference between full tax invoice and simplified tax invoice, just to make it practical for the retailers, and also because indeed for consumers, you don't need all of their address details and the
Sure.
VAT registration numbers. So that's the practical thing about having the simplified invoice. But you would still need to be able to comply with the minimum invoice requirements, because you are obliged to issue an invoice, not for your customer, but from your own administration perspective, because you are applying VAT on that, and that VAT should be administered and shown on your tax invoice.
And Dermot, over there, one may ask that, can I claim input tax on the basis of a simplified invoice? So long as it's a valid simplified invoice, the answer would be yes, because it is a tax invoice at the end of the day. It's just an abridged version of the tax invoice. It doesn't hamper the claim of the recipient to claim input tax on the basis of a simplified invoice, so long as the claim is eligible.
Okay. And I guess, Julie, that just on the follow-up to your point, if there's a threshold under which you can only use a simplified invoice, I guess if frontline staff in the retail environment are going to need to know if a transaction exceeds that actually that then requires a full invoice rather than the simplified invoice, if that's what's ultimately decided in the executive regulations.
Yeah, so if I take UAE as an example, there is a threshold under which you don't need to issue a full tax invoice, but UAE gives a blanket exemption from full tax invoice for B2C transactions. So whenever your sale is to a private individual, so for example, you are selling a car, you are selling, I don't know, very expensive luxury goods, you would still be good enough with a till receipt, even if the sale is in UAE case 10,000 dirhams. So till receipt will still be fine, but if you're, say, a furniture store and a B2B transaction happens through your furniture store, you would need to issue a full tax invoice for those maybe office tables and chairs that you might be selling.
Okay, so it's going to be important. Thanks both. Those last two questions, and one is all, Ava, I think you've already answered, which was the question is about monthly free of goods gifts are given to employees. I think you covered that in the team supplies answer you gave earlier. I don't know if there's anything you wanted to add. And then the last one is an invoice received from the hypermarket for a staff canteen may not include the company name. Is VAT input eligible? Abba, do you want to take that one?
Yeah, so that goes with my answer on the simplified invoices earlier. So you would, assuming that the hypermarket has, so the hypermarket may not issue a full tax invoice to you. The hypermarket may issue a simplified tax invoice to you. As a recipient, it's your responsibility to make sure that this is a valid simplified invoice. If it's a valid simplified invoice, carries all the contents required on a simplified tax invoice, and the expense that you've incurred is eligible for recovery, you can claim input tax on the basis of it. If it's ineligible, you can't.
Great, great. Okay, I'm conscious we've run 10 minutes over time, so I think everybody is exceptionally busy, especially with 37 days to go and 142 days to the filing of the first VAT return. So it's not, it's imminent for everybody in Oman. Thank you, Abba and Julie, and to Ken in absentia. He had to go to something else. And thank you all the participants for your questions and your engagement. We hope you found it useful. Please do fill in the feedback questionnaire, and we look forward to talking to you again soon. Thanks very much. Bye-bye now.
Thanks, everyone. Have a good day. Bye.